Hi, I'm Sonali Basak. I am the Chief Investment Strategist at iCapital. Welcome to the latest episode of Beyond 60/40, and today we are joined by Robert Koenigsberger. He is the founder and managing partner and Chief Investment Officer at Gramercy Funds Management. Gramercy operates around the globe. You see things that a lot of investors don't get to see, particularly in emerging markets. It's a hard place for a lot of people to understand. It's also, Robert, a hard place for people to feel comfortable with because of their lack of understanding. How do you really get down to what the problem is and how people are thinking about emerging markets?
Sure. And thank you for having me here today. I think the challenge that people have had in investing in emerging markets is they've thought of it more about yes, no, and not how. And that's not really the approach they take to developed markets, right? They think about, do I want to be in equity? Do I want to be in fixed income, growth, what have you? In emerging markets, it tends to be a later cycle decision that people have made. And there's been this strange dance that investors have had between fear and FOMO. And there's been cycles that have coincided with that. So you have a huge rally like you've had this year in emerging markets, particularly emerging markets local debt, right? And everyone was sitting on the sidelines from the fear of the last dislocation. So now they go chase it. And what people tend to do is they buy the wrong thing at the wrong time. They stick with it for too long, and then they capitulate, and they blame it on the asset class. So we think there's an alternative approach, a better approach, which is to anchor what you do in emerging markets with high conviction, right? They've come to this asset class historically with low conviction. What do? They come and they buy an index. And I believe indices have done more damage to emerging market investors than any potential idiosyncratic event. These indices draw people into buying things that they don't know and understand at a low conviction basis. When I launched Gramercy back in 1998-99, Argentina was like 18% of the index. We were already writing research about the coming default in Argentina. So why would we want to put 18% of our capital there? And you could say, and they did default the following year. You could say that's a long time ago. Well, in 2022, that same index put people into Russia and Ukraine. So we think the better approach is anchor your portfolio in high conviction yield. And then when you have high conviction yield, it prevents you from making mistakes that people do, which is wander into other places that they don't know and understand. And those are the things that people always talk about. They talk about that one investment they made, they wish they hadn't made, and then they blame it on the entire asset class.
Well, it's interesting. When I asked you about how to think about this, something that struck me was it's not really always about the country. Often it's more about the idiosyncratic risks you're taking within those countries, is how I understood it.
Correct. I've been doing emerging markets for 38 years. And I don't like emerging markets and emerging market risk, the way that people think about it. I think people came into this asset class on a story of convergence and come along for the ride. And quite frankly, it did happen. But people didn't come along for the ride. They got whipped around by the ride. So to your point, I think emerging markets is less about the beta and less about if you're going to be in it, how you do it. There's so much being talked about in the capital markets today about private credit. Private credit's a great example of a much more intelligent way to approach emerging markets risk than to simply buy an index. Emerging markets private credit is like developed market private credit 15 years ago. Really high yields, no leverage, collateral, uncorrelated collateral, senior secured. So you get asymmetric return profiles similar to what you were seeing from the Apollos of the world in 2008, 2009. And in EM, in the index, you could own something like a Pemex bond and get 6, 7, 8%. And it's supposedly liquid until you want the liquidity, but it's unsecured. It comes with a bond trustee and a collective action clause, which means you don't bake it and you don't restructure it. We would rather do things like lend to suppliers of Pemex in US dollars, get senior secured collateral, uncorrelated collateral, which means things that have nothing to do with the business that the families may own. And we're able to do that at like 1,000 basis points above where the bonds trade.
So is part of this also because of what the financing structures look in a lot of these markets? One big reason for growth of private credit, even in the United States, is the lack of the ability of the banking system to get to the borrowers.
Yeah, I think in emerging market private credit, we're solving for a market failure. That market failure is a lot of what you just referred to, which is the banks aren't present. Not just the local banks, but if you think about it, go back to 2007, 2008, Lehman, Bear, Credit Suisse, JP Morgan, they were all doing private credit. Deutsche Bank were doing private credit. Well, Volkswagen no más on that. So it created this sucking sound for capital. At the same time, large corporations in Latin America, what have you, like to be included in an index, you need to be issuing about 300 million. Well, there's a lot of great companies that don't need $300 million worth of debt, maybe 25 or 50. Strong families, strong groups. So you can structure good collateral-backed deals that allow them to grow without the constraints and the challenges that they've had with private equity or not having access to debt markets.
Do you find yourself, it's interesting, you're talking about two types of investments that a lot of people are either not that familiar with or are asking a lot of questions about lately. So we talked a little bit about emerging markets itself, but private credit also. Right now, there's a new set of questions really emerging around the asset class. How do you think about this in the context of what you do? When people are thinking about what credit defaults can look like into next year, when people are thinking about base rates declining and potential return profiles declining in private credit, what does that mean for you when you're investing in markets that are not as developed?
Yeah, I think you have to detach from the labels to the actual transaction. And for us, when we do private credit, there's it's not one size fits all. It's very bespoke, idiosyncratic structuring. So for us, private credit is really direct lending. It's asset backed. It's going into a place like Mexico or Turkey or what have you, and thinking this isn't about we necessarily love Mexico or we love Turkey, but we love the ability to go into a market where there's a market failure, where the banks aren't doing what they should have done or used to do, and there's great structure available and a lack of competition. I think the big difference between emerging market private credit and what you see in developed markets is, if I go to a place like Turkey or Mexico, we're not competing with others with term sheets. And if a borrower says, hey, someone else put in a term sheet, do you want to compete? No, that's just not the game we want to play. So I think it's still very much a lender's market.
Well, it's interesting, too. It sounds like there is a fair degree of downside protection baked in. A lot of people are talking about asset-based financing. Interestingly enough, it's actually really hard to get a lot of access, especially for individual investors to asset-based financing. But this is something you're doing at a greater scale in these markets.
The availability of collateral is a function of whether there's availability of capital without collateral. And so, again, if you go to developed markets and when people are competing as much as they are in developing markets, what do you see? You're seeing lesser and lesser credit terms, lower and lower rates, covenant light, what have you, because ultimately it's a race to the bottom. Someone's going to take that. In emerging markets, we're just not seeing that, right? So if you're dealing with borrower ABC in Mexico, and it's 0-1, they're either going to get a loan or not. We're going to be reasonable, but we need reasonable protection.
It's interesting. I want to point back to an article that you wrote, an op-ed in the Financial Times earlier in 2025. The reason I want to point this out is my question will be around where does the macro play a role in the type of investing that you do. You wrote, undoubtedly there are concerns about a slowdown in global growth, but individual countries and borrowers warrant a deeper look. How do you address those potential hiccups in the macro as it pertains to where you're investing?
Sure, it's a great question. And I don't want to leave the impression that macro doesn't matter, right? And in fact, we are working with one of the most brilliant top-down decoders in the world, Mohamed Al-Arian, right? So the way we think about macro is let's make sure that the macro top-down informs, influences, and from time to time imposes a view on our portfolios. And an imposition may be that we've decided that whatever's going on in the geopolitical world or idiosyncratic to the top-down in that country, that it just doesn't warrant investing. So whether we're doing public credit or private credit, it's a marriage of the top-down and the bottoms-up. And ultimately, I think historically we've been really strong at the bottoms up. Over the last 5 years, we've really built the top down. And what we want to make sure of is that we don't buy good homes in bad neighborhoods. And that's where the macro really comes in.
It's interesting. I talked to you a little bit about what countries you are feeling a little more bullish about. And I'm curious about what those macro forces are that you do like, talking about the good homes and bad neighborhoods. What are the good neighborhoods? You've said Mexico is a place that you're really bullish on lately.
Sure. And that call can come from both the macro and also the bottoms up, right? So Mexico is a great example where, the world's gone from globalization to regionalization. And with that, the spheres of influence and what have you. And Mexico is blessed to be close to the United States. And it's turned out to be a great re-alternative to China, because there was a time under the Maquiladora program and what have you that a lot of manufacturing happened in Mexico and then it went to China. So what's gone on with the trade war and what have you, Mexico's a winner. And this whole notion of nearshoring and reshoring and friendshoring, Mexico's a winner. That's not enough, right? That's not enough to say, hey, let's go lend in Mexico. That gives us a bit of a tailwind, but we still need to get very concerned about the individual structure. I could go to another place like Turkey and say, many people would say the macro story is kind of challenged. And again, maybe that's why the banks have been forced to not lend. Well, that doesn't mean that we're not necessarily willing to go to a market like that if we can get the right structure, the right collateral. I mean, in the U.S., good luck lending to someone and saying, they'll actually give you the mortgage. Like forget the mortgage, you get the title, right, to the collateral. They pledge the collateral, the mortgage, what have you. We can go to places like Turkey and say, look, if you want us to lend you X dollars, we don't want to pledge to that hotel. We're going to take ownership of that hotel. And when you pay us back, we'll give it back to you, just to try and mitigate as much risk as possible. That's possible maybe because Turkey isn't the macro environment that everyone would like it to be, but it creates the micro opportunities if you know how to structure around them.
It's really interesting. You also wrote recently for a piece for your own fund that there are two competing narratives regarding the future economic outlook. The optimistic one anticipates a path towards a fairer global trading system through creative destruction, with the U.S. securing concessions from its trading partners and potentially benefiting from looser monetary policy and tax cuts. But there's a pessimistic view there as well. Protracted negotiations, retaliatory tariffs, constraints on the Fed and its ability to lower interest rates. I guess where do you fall on that spectrum of optimism and pessimism about the future of the world here? People could talk about the Trump administration's role in this, but you could also go back to COVID too and talk about that change in globalization that we're seeing.
The reality is, whether I'm optimistic or pessimistic, it doesn't matter. We have to account for both scenarios, right? And I think sometimes when you are optimistic or not, that's a bias, and the biases can get you in trouble. We went into this past year thinking it's really hard to have conviction because of those two poles. What it gives us conviction on, our highest conviction, is in a world of low conviction, you're going to have volatility. We could be optimistic, we could be pessimistic, others could be optimistic, could be pessimistic. The reality is we keep getting more and more information. The world's become data dependent, and something happens and markets react really quickly. So we want to anticipate volatility. We think volatility is your friend. If you anticipate it, you embrace it, and you do things like buy low and sell high. And I know that sounds kind of crazy, but usually people don't like volatility because it shakes them. They kind of capitulate at the bottom and they capitulate at the top. We like to anticipate volatility, plan the trade and trade the plan, which means we think that maybe treasuries could be at X or Y. Well, when it gets closer to X, we should sell. When they get closer to Y, we should reload. It can be that simple.
And it's funny, to your point, this should be a basic thought, but as we've seen the way the market's been going, it's been a momentum market where a lot of people have been chasing returns. To your point, maybe we are in that FOMO moment at a point where people have bought high and might be stuck with the bag in a lot of places.
Right. And I think when we had Liberation Day in 2025, we saw how quickly people could go from FOMO to fear. Right. And that's why, again, when we build portfolios, we have to build them in high conviction and that will weather whatever the volatility may be.
So I also want to talk a little about how you see the planet shaping up right now. You see a lot of moves from the Trump administration in other countries, and it will have significant impacts in those countries, but also back in the United States as well. Would love to get your opinion on Latin America in particular. A lot of headlines around Venezuela earlier in 2025, Brazil as well. What does all of this amount to in the end?
Sure. In the beginning, I was a student of Latin American history and politics, and I feel blessed to kind of have that background as I answer that question and think about those issues. We've been through an era of 35, 40 years of globalization. Globalization is evolving towards regionalization. The region that's most close and present to the United States is Latin America. And if you go back to the 1823, 1824, you had the Monroe Doctrine. And the Monroe Doctrine was a warning to the Europeans that the Americas are for America. And then you had the Roosevelt corollary to that, which says, from time to time, we'll even use military force if necessary to enforce control within the Americas. And then that got lost for a long period of time. It got lost in globalization. And I think in part what the Trump administration is doing today is, in a world of regionalization and spheres of influence, reimposing U.S. influence on that sphere.
So what does that mean then, ultimately? Kind of taking the crystal ball, looking 10 years out. If you sit here today and you look at what's happening, I think the immediate question for a lot of Americans is, okay, what impact does this have at home? The immediate impact you could see, for example, is in oil prices, in commodity prices. They've been fluctuating pretty wildly in recent months. And, a lot of people would walk away saying, okay, is this making prosperity at home better at the end of the day, or is it not about that in the end?
It's in part always about that. But I'd say one of the biggest things that might influence is immigration. And I think when you think of sphere of influence and what the Trump administration may be trying to do, you go back to Argentina, right? And they went through a midterm election earlier this year that was very digital in terms of what the outcome might be. Continuation of right reforms under the Milei government, or going back to maybe what the Peronists were doing. If you look at what's going on in perhaps Venezuela today, I mean, the obvious answer is it's about oil. But they only do, at the peak they did 2.4 million barrels a day. They're doing 800,000 barrels a day. It's not that big. I think it's more about immigration, and that if the Americas are prosperous, then there's less demand to immigrate to the United States. Now, take Venezuela, for example. If there were regime change in Venezuela, I think there's great parallels to Iraq a few years ago, which when the U.S. left Iraq, they were doing about 1 million barrels a day. Today, they're doing 5 million barrels a day. The economy was 25 billion. Today's 250 billion. So there's huge potential idiosyncratic for Venezuela. Of course, that would put more oil on the oil market. The oil that comes from Venezuela is strategic to the U.S. because the refineries in Louisiana and elsewhere, they're set up for that style, that heavy crude oil. So certainly that would be one of the beneficiaries. But I don't think that's the pure motivation. I think it goes back to the Monroe Doctrine, or shall we call it the Trump corollary to the Monroe Doctrine.
Yeah, it's interesting. All of this, for me, was a fancy way of asking how much of this is about oil in the end. Energy, natural resources. You think about the conversation globally around rare earth minerals. How much of that is driving the conversation, or do you think that people are missing the true point?
Look, I think COVID was a great amplification of this regionalization, of moving away from globalization. And that's because we're moving from a just-in-time world to a just-in-case. And what we learned is this wired system that we had before COVID had its negative externalities. And one of them you mentioned is like rare earths and what have you. So I think one of the things that COVID has taught these different spheres of influence is you need to be able to survive in a world where that's all you have. Where rare earths could be cut off from a place like China. And a place like Venezuela, as you mentioned, rare earths are really important.
Now, it's interesting. I want to kind of flip the script here. We've been asking so much about emerging markets and other areas of the world, but really I also want to just get your thoughts on the United States, because there's been a lot of questions around the dollar. There's been a lot of questions around the U.S. versus China, and really control over both nations, that the control that they might have over different parts of the world. You started to get at that a little bit with Latin America. How do you see the stance of the U.S. changing over time? The reserve currency, our relationship to many of the countries that you operate in?
We all came into this year post-Liberation Day, and everyone thought there'd be this huge move away from the U.S. And I think that's a great thing to aspire to, perhaps, but I think it's really difficult to execute. So if you're going to go from something, you have to go to something else. So what is the something else? So if you talk about reserve, you're going to move away from the dollar. What is it? So I think anything but U.S. is really difficult. And I remember seeing an interview with one of the heads of the sovereign wealth funds in the Middle East, and I thought it was great. He said, short the U.S. at your own peril. Because where else do you have the depth, the breadth, and the property rights that you have in the U.S.? It's not perfect by any means. But look, I think the dollar's stuck in a range. I think it was overvalued going into the year. I think we've seen the big move of the anything but dollar. But it's hard to get depth and scale elsewhere.
So I have a big prediction for you then for 2026. Do you think that globalization is going to be more tense of a story in 2026? Or do you think that there's actually going to be some resolution in different areas of the world? Geopolitics, do you think that frictions are going to rise?
So look, my fear is this 35 of 40 years of globalization that was anchored in peace was extraordinary in world history, right? And if you go back 100 years, 200 years, what have you, we had regionalization for a reason, because we didn't have that peace. So I think we'll continue to have volatility around that narrative. You see what's going on with trade. I think, it hasn't just been about tariffs. It's been about the weaponization of trade, which is all just part of this regionalization. And the reality is we don't know. We have to be prepared for, and we need to structure for the world that's coming, not the world that we're coming from.
Robert, that's a great place to leave it on. That is Robert Koenigsberger. He's the founder, managing partner, and chief investment officer at Gramercy Funds Management, and a view from around the world.